Hello and welcome back to the channel. My name is Ali Akbar and in today's video we'll delve into the power of candlestick chart for understanding price movement. I'll guide you through interpreting candlestick representation across various time frames, breaking down their components, associating colors with bullish or bearish trend, and examining the significance of upper and lower shadows. We'll explore different candlestick patterns such as hammer, shooting star, engulfing, and morning star, highlighting their role in indicating bullish or bearish trends. Recognizing these patterns is crucial as they often serve as signals for potential upward or downward momentum in the market. Moreover, we'll take a deep dive into the technique of candlestick matte blending, designed to help you identify potential trading opportunities. To showcase the effectiveness of candlestick matte blending, I'll blend several well-known candlestick patterns and compare the result with powerful patterns like the hammer and shooting star. Make sure to stay tuned until the end of this video to witness the compelling insight that candlestick matte blending can provide. So please stay tuned. History and origin of candlestick charts. Candlestick charting originated in 17th century as a tool for trading rice in Japan. The credit for developing candlestick pattern is given to Monohesa Homa, a Japanese rice trader who conducted extensive research on price pattern recognition during the 18th century. In 1991, Steve Neeson introduced candlestick charts to the Western world through his groundbreaking book, Japanese Candlestick Charting Technique, leading to their global popularity. Today, traders use different types of charts for technical analysis, such as bar charts, line charts, and candlestick charts. However, candlestick charts are the most widely used and preferred by traders due to their effectiveness in highlighting trends and patterns. These charts provide valuable insight into market sentiment and price action, making them a powerful tool for technical analysis across various financial markets such as stock, commodities, and currencies. Unlike bar charts and line charts, candlestick charts are particularly effective in identifying and interpreting trends and patterns, which is why traders prefer them for technical analysis purposes. Components of a candlestick: open, close, high, and low. Candlestick charts consist of individual candles, each representing a specific time frame, with the open, close, high, and low prices providing important information about market sentiment during that period. In this bullish candle, represented by green color, the close price is above the open price, and the high and low prices show the maximum and minimum levels price reached, respectively. By analyzing the relationship between these prices, traders can identify candlestick patterns that provide insights into market sentiment and help predict future price movements. Additionally, the length of candlestick body and wicks can provide valuable information about price movements and volatility. Overall, candlestick charts are a powerful tool for technical analysis, allowing traders to make informed decisions based on market sentiment and price action. This is a bearish candle represented by a red color, where the close price is below the open price. The open price is the first traded price during a given time period, while the close price is the price at which the financial instrument ended trading during that period. The high price above the upper wick signifies the highest price reached, and the low price below the lower wick indicates the lowest price reached during that time frame. Traders and analysts use these prices to evaluate market sentiment and predict future price movements. Candlestick pattern and formation can be identified by considering the relationship between these prices. The length of the candlestick body and wicks provide valuable information, with longer bodies indicating significant price movements and longer wicks suggest increased volatility. This information helps traders and analysts interpret price patterns, identifying potential reversals or continuation, and make informed trading decisions. Importance of time frame in candlestick charts. Time frames play a crucial role in candlestick charts as they determine the duration or length of each candlestick and provide different perspective on price movements. Here are a few key points. Number one, granularity of price data. Different time frames provide varying levels of granularity in price data. Shorter time frames offer a detailed view of price movements within a specific trading session, while longer time frames provide a broader view of price trend. Number two, identifying short-term versus long-term trends. Analyzing candlestick charts across different time frames helps traders differentiate between short-term and long-term trends. Shorter time frames reveal short-lived price movements, while longer time frames provide a clearer picture of the overall trend. Number three, confirmation and validation. Time frames can be used to confirm or validate potential trading signal observed on different intervals. Finally, risk management. Time frames influence risk management decision. Shorter time frames may require tighter stop loss levels, while longer time frame may allow for wider stop loss level to account for potential price retracements. It is important to select time frames that align with your trading goals and strategies. Demonstrate of constructing a basic candlestick chart. To construct a basic candlestick chart, we start by collecting the necessary data for the time period you want to represent in your candlestick chart. This data typically includes the open, close, high, and low prices for each time period, such as day, hour, week, or even 1 month. In this graph, we use the hourly time period. The horizontal axis is divided into 7 1 hour, and the vertical axis is the price range from $20 to $33. To begin constructing the graph, let's draw the grid first. And this is the horizontal axis, and let's assume these numbers on this axis are candles formed in different time interval of 1 hour. This is the vertical axis. This chart represents price scale of open, close, high, and low prices of the time period you are representing. If the open price of the candle be above the close price, the color of the candle is red, and it is a bearish candle. If the open price of the candle be below the close price, the color of the candle is green, and it is a bullish candle. So this is the information for the first candle, and that's candle number 1. Information for the second candle, and that's candle number 2. Information for the third candle, and that's candle number 3. Information for the fourth candle, and that's candle number 4. And candle number 5, candle number 6, and this is the information for the last candle, and that is candle number 7. So this is how you construct candlestick chart on this graph. Introduction to candlestick patterns. Candlestick patterns are formed by a combination of candlestick on a chart and provide valuable insights into price movements and potential trend reversals. These patterns are widely used by traders and analysts to make informed trading decisions. Here are a few key points. The first one is bullish and bearish candlesticks. Candlesticks pattern categorized into bullish and bearish patterns. A bullish candlestick indicates buying pressure and suggests that the price may increase. It typically has a higher closing price than the opening price, resulting in a filled or colored body, often white or green. Conversely, a bearish candlestick like this signifies selling pressure and suggests that the price may decrease. It usually has a higher opening price than the closing price, resulting in a filled or colored body, often black or red. Number 2, doji candlestick. This pattern occurs when the opening and closing price are very close or equal, forming a small or non-existent body. This pattern suggests indecision in the market and potential trend reversal. Different doji candlesticks are as follow. Number 1, doji star. This pattern occurs when the opening and closing price are formed almost at the same level, resulting in a small or non-existent real body and long upper and lower shadows. The doji star pattern is significant because it indicates that the market is indecisive, with neither buyers nor sellers having a clear advantage. It is often interpreted as a sign of potential trend reversal or a period of consolidation. Number 2, long leg doji. This pattern has a long upper and lower shadows and a small or non-existent body. It indicates indecision in the market with buyers and sellers in a deadlock. Number 3, dragonfly doji. This pattern has a long lower shadow and very small or non-existent upper shadow with the opening and closing price near the high of the period. It suggests a potential reversal from a downtrend to an uptrend. Number 4, gravestone doji. This pattern has a long upper shadow and a very small or non-existent lower shadow, with the opening and closing price near the low of the period. It suggests a potential reversal from uptrend to a downtrend. And finally, 4 price doji. This pattern, also known as coma doji, Has all four prices open, high, low, and close are equal or very close to equal. It indicates extreme market indecision and can suggest a potential reversal or continuation depending on the context of the pattern's appearance in the chart. Number three, bullish and bearish engulfing pattern. The engulfing pattern is a popular technical analysis pattern that can be either bullish or bearish. A bullish engulfing pattern occurs when a large bullish candle completely engulfs the previous smaller bearish candle. And this pattern often appears at the bottom of a downtrend, signaling a potential uptrend reversal. On the other hand, a bearish engulfing pattern is observed when a big, strong bearish candle engulfs the previous small bullish candle. And this pattern usually shows up at the top of a downtrend, conveying a strong bearish signal for a potential downtrend reversal. Later in this video, I will further illustrate how this pattern works. Number four, reversal and continuation pattern. Candlestick pattern can be classified into two main types: reversal patterns and continuation patterns. Reversal patterns indicate a potential shift in the direction of the price trend and can signal the end of a bullish or bearish trend, suggesting that the reversal may be on the horizon. On the other hand, continuation patterns suggest that the existing trend is likely to continue after a brief period of consolidation or pause. While a complete discussion of these patterns is beyond the scope of this video, I plan to cover them in detail in further videos. And finally, number five, importance of confirmation. When it comes to identifying candlestick pattern, it is important to remember that additional factors should be taken into consideration for confirmation. Volume analysis, support and resistance levels, and presence of other technical indicators are often used by traders to validate a pattern and increase the likelihood of a successful trading decision. I plan to cover these aspects in greater detail in my future videos. In conclusion, candlestick patterns are powerful tools that traders use to analyze price movement and make informed trading decisions. These patterns provide insight into market sentiment, trend reversals, and continuation patterns, enabling traders to enhance their technical analysis and potentially improve their trading outcomes. Anatomy of a bullish candlestick: body, upper and lower shadows. A candlestick consists of three main components: the body, upper shadow, also known as upper wick, the lower shadow, also known as the lower wick. Understanding the anatomy of the candlestick is essential for interpreting price action and market sentiment. Let's assume this is an empty candle represented by the yellow color with daily time frame. The price opened right here at this location when the market opens in the morning. If the price drop further, it will indicate with the red color. However, if the buyers step in and reject the lower price, the price will move upward and leave a lower shadow until it reaches the open price, and this is the lowest price for the duration of this candle. If the price continues to rise, it will indicate with the green color, representing the upward movement. Now, if the sellers reject the higher price, the price will come down, leaving an upper shadow, and this is the highest price for the duration of this candle. The candlestick then will close at this location when the market closes in the afternoon, and this is how a bullish candlestick is formed. Anatomy of bearish candlesticks: body, upper and lower shadows. Understanding the anatomy of candlestick allow traders to interpret price action more effectively and make informed trading decisions. By analyzing patterns formed by candlestick's body, upper and lower shadow, traders can identify potential trends, reversals, and key price levels. Analyzing these components help traders gauge market sentiment and potential price reversals, contributing to more informed trading decisions. Let's assume this is an empty candle represented with yellow color and daily time frame. The price open at this location when the market opens. If the price go up, it indicates with the green color. However, if the sellers reject the higher price, then the price will go down all the way where the market opens, leaving an upper shadow, and this is the highest price for the duration of this candle. The price continue going downward, indicated with the red color, all the way down, and then the lowest price was rejected by a strong buyers in the market, leaving a lower shadow, and this is the lowest price for the duration of this candle or time frame. Then the candle closed at this point where the market closed, and this is how a bearish candle is formed. Significance of the candlestick body size and color. Candlestick body size and color provide important information for traders to analyze price action and market sentiment. A large body suggests a greater price movement, while a small body indicates a narrower range. A large bullish body signifies a strong buying pressure and a bullish sentiment, while a large bearish body suggests a strong selling pressure and a bearish sentiment. A small body reflects weaker buying or selling pressure and potential indecision. The color of the body indicates the relationship between opening and closing prices, with green indicating a bullish sentiment and red indicating a bearish sentiment. Traders consider the relationship between body size and color to gain more insights, but should use additional analysis and indicators for accurate interpretation. Body size and color, key indicators of market behavior. The size and color of candlestick in financial trading charts can provide valuable information about the market's behavior. The size of the candlestick body can indicate the strength of the buying or selling pressure, with larger bodies indicating stronger momentum. On the other hand, the smaller bodies can suggest a lack of conviction from traders. Additionally, the color of the candlestick body can reveal the direction of the price movement. In general, we have three basic candles. The first one is bullish candle. The second one is bearish candle. And finally, the third one is indecisive candles. This is a bullish candle with large body and the color is green. The larger body and larger range indicates a stronger momentum, and it shows an increase in price since the close price of the candle is above the open price. Traders can make an informed decision whether to buy, hold, or sell this stock by investigating the relationship between this candle and the preceding one. This is a bearish candle with large body and the color is red. The larger body and larger range indicates a stronger downtrend momentum, and it shows a decrease in price since the close price of the candle is below the open price. Traders can make an informed decision whether to hold, buy, or sell this stock by investigating the relationship between this candle and the preceding one. Finally, this is three doji candlesticks, each exhibiting distinct characteristics that are useful in technical analysis. A doji candlestick pattern typically has a small or non-existent real body with the opening and closing prices close or equal to each other. The length of the upper and lower shadows can vary, but they are usually longer than the real body. The upper and lower shadows represent the high and low prices of the day. The doji candlestick pattern is often represented as a neutral or indecisive pattern, indicating that the market is uncertain about the asset's direction. However, it can also be viewed as a potential reversal signal, depending on the previous trend and other technical analysis indicators. Interpreting upper and lower shadows. The upper and lower shadows provide valuable information about price action and market sentiment. Traders analyze these components to understand the high and low reached during a specific time period and to anticipate potential price reversal or continuation. Upper shadows. The upper shadow represents the highest price reached during the time period. It indicates the level of selling pressure or resistance encountered by the price. Long upper shadow suggests that the price reached significant highs before reversing or pulling back. It indicates that sellers were active at those higher price levels, resulting in a rejection of further price increase. This can be an indication of potential resistance or a bearish sentiment. Short or no upper shadow. A short or non-existent upper shadow indicates that the price did not encounter much selling pressure or resistance at higher levels. It suggests that buyers were able to push the price higher without significant opposition. This can be a sign of bullish sentiment and a potential continuation of an uptrend. Lower shadows or wicks. The lower shadow represents the lowest price reached during the time period. It indicates the level of buying pressure or support encountered by the price. Long lower shadow suggests that the price reached significant low before rebounding or recovering. It indicates that buyers were active at those lower price levels, preventing further decline. This can be an indication of potential support or a bullish sentiment. Short or no lower shadows. A short or non-existent lower shadow indicates that the price did not encounter much buying pressure or support at lower levels. It suggests that sellers were able to push the price lower without significant opposition. This can be a sign of bearish sentiment and a potential continuation of a downtrend. By analyzing the lengths of presence of upper and lower shadows, traders can gain insight into market sentiment and potential price reversal or continuation. It is important to consider these shadows in relation to the candlestick body and other technical factors for confirmation and accurate interpretation. Excellent tip nobody tell you. How do you know a pin bar is bullish or bearish regardless of the color? Let's assume you have these 8 pin bars, the same length, and the body of all these pin bars lies above the midsection of the total length. Now, you can consider all these pin bars as a bullish power regardless of the color. But the strengths of the bullishness of each pin bar depend on the combination of these factors. The location of the body relative to the total length, the size of the body, and the color of the body. Now I can tell you these two pin bar you can consider it as bullish hammer. This one you can consider it as bullish hammer, regardless of the color. Let's assume these are all pin bars and the length of the pin bars that are the same. The body of all these pin bars lies below this midsection. You can consider all these pin bars as a bearish power pin bar, regardless of the color. However, the strength of the bearishness of each pin bar depend on the combination of the location of the body relative to the total length, the size of the body, and the color of the body. You can consider these two as a bearish pin bar, regardless of the color. However, this is more bearish than this one. That's obvious because the color is red. Rising and falling power that you should remember. Look at this graph. The first two is no shadows. This one is obvious rising power because it's bullish. This is a falling power. That's obvious because it's bearish. Look at this one. Only upper shadow. These two has only upper shadow. The first one is weakening rising power. The second one is increasing falling power. Now these two, no upper shadow, only lower shadows. The first one is this bullish, increasing rising power. And the second one is bearish, weakening falling power. So that is very important that when you look at these uh, candles, you should remember this graph. The last section I'm going to talk about is overview of common candlestick patterns. Candlestick patterns are widely used in technical analysis to analyze price charts and predict future price movements. These patterns are formed by combination of candlesticks and provide insight into market sentiment and potential trend reversals or continuations. Here are a few common candlestick patterns that I'm going to discuss in this video. The first one is bullish hammer reversal pattern. The second one is bullish engulfing reversal pattern. The third one is bullish morning star reversal pattern. The fourth one is bearish shooting star reversal pattern. And finally, the last one is bearish engulfing reversal pattern. Bullish hammer reversal pattern. The bullish hammer reversal pattern is formed after a price decline, and it is seen at the bottom of this downtrend. It is characterized by a small bodies candle near the top of the overall price range with a long lower shadow or wick, and little or no upper shadow. The long lower shadow of the hammer indicates that buyers were able to push the price higher from its low, showing strength and buying pressure. The small body represents a narrow range between the opening and closing prices. The hammer pattern suggests that sellers pushed the price lower during the session, but the buyers managed to regain control, leading to a potential trend reversal. Traders look for confirmation signal such as this bullish candle or a higher closing price in subsequent session to confirm the hammer pattern. This pattern often signals a potential bullish reversal, especially when it appears near support levels or in oversold conditions. Bearish shooting star reversal pattern. The bearish shooting star reversal pattern is formed after a price increase in an uptrend and it is seen at the top of a downtrend. It is characterized by a small body candlestick near the bottom of the overall price range with a long upper shadow or wick and little to no lower shadow. The long upper shadow of the shooting star suggests that sellers were able to push the price lower from its high, showing strength and selling pressure. The small body represents a narrow range between the opening and closing prices. The shooting star pattern suggests that the buyers pushed the price higher during the session, but sellers managed to regain control, leading to a potential trend reversal. Traders look for confirmation signal such as this bearish candle or a lower closing price in subsequent session to confirm the shooting star pattern. This pattern often signals a potential bearish reversal, especially when it appears near resistance level or in overbought conditions. Bullish engulfing reversal pattern. The bullish engulfing is a bullish reversal pattern that forms after the price decline and it is seen at the bottom of this downtrend. The first candlestick in the pattern is a small bearish candle, indicating that sellers are in control of the market. The second candlestick is a large body bullish candle open lower than the previous candle's close, but then closes higher than the previous candle's open. This causes the second candlestick to engulf the first candlestick, hence the name of bullish engulfing. The bullish engulfing pattern indicates a shift in market sentiment from bearish to bullish as buyers have taken control of the market. The large size of the second candlestick in the pattern suggests that buyers are in control of the market and are driving price higher. This bullish sentiment is confirmed by the fact that the second candlestick closed higher than the previous candlestick's open, indicating a strong buying pressure. The bullish engulfing pattern is considered as a strong bullish reversal signal, especially when it occurs after a significant downtrend. Traders often use the bullish engulfing pattern as a signal to enter long position or to close out their short position, as it suggests that the market is shifting in favor of buyers and that the trend may be reversing to the upside. Bearish engulfing reversal pattern. The bearish engulfing is a bearish reversal pattern that forms after price increase to the upside, and it is seen at the top of this downtrend. The first candlestick in the pattern is a small bullish candlestick, indicating that buyers are in control of the market. The second candlestick is a large body bearish candles open higher than the previous candles close, but then close lower than the previous candles open. This causes the second candlestick to engulf the first candlestick, hence the name of bearish engulfing. The bearish engulfing pattern indicates a shift in the market sentiment from bullish to bearish as sellers have taken control of the market. The large size of the second candlestick in the pattern suggests that sellers are in control of the market and are driving the price lower. This bearish sentiment is confirmed by the fact that the second candlestick closed lower than the previous candlesticks open, indicating a strong selling pressure. The bearish engulfing pattern is considered as a strong bearish reversal signal, especially when it occurs after a significant uptrend. Traders often use bearish engulfing pattern as a signal to enter short position or to close out their long positions, as it suggests that the market is shifting in favor of sellers and that the trend may be reversing to the downside. Morning star bullish reversal pattern. The morning star pattern is a bullish candlestick chart pattern that typically indicate a potential reversal of a downtrend. It consists of three candles. The first one is a long red bearish candle, indicating that the bears are in control of the market. The second one should be a small body bullish or bearish candle that gaps lower, showing indecision in the market and potentially signaling a weakening of the bearish trend. The third candle should be a long green bullish candle that closes above the midpoint of the first candle's body, indicating that buyers have gained control and potentially reversing the prior downtrend into an uptrend. This is how morning bullish reversal pattern is formed. Some traders enter a long position as soon as the fourth candle passes above the high of the third candle as a confirmation signal and put their stop loss a distance below the second candle in the pattern. This is how traders use Morningstar to enter the trade. Candlestick matte blending. There are hundreds of patterns and formation out there like hammer, shooting star, engulfing, three white soldiers and three black crews, morning and evening star, tweezer top and tweezer bottom, dark cloud cover, Tatsuki upside and Tatsuki downside, three inside up and three inside down, and so much more that memorize their name and complicated instruction is cumbersome and confusing. With candlestick matte blending, you do not need to memorize their weird name. You can blend them even with your own naked eye and find the equivalent. When you blend 2, 3, 4 or more candles with candlestick matte blending, you certainly capture the essence of the pattern and find the exact entry and exit point with a big probability. You will be able to have a sharper view of the market and spot a wonderful trading opportunity. When you blend almost all these patterns, the equivalent is nothing but bullish or bearish hammer or inverted hammer. That is the reason they claim these patterns are so powerful. Let's blend morning star and bearish engulfing that we have covered already in this video and find out the equivalent. Let's say this is a morning star. To blend this morning star, it's so easy. You can take the open of the first candle, you take the close of the last candle, you take the portion between open and close, then you take the high and the low of the pattern. The equivalent is nothing but a strong hammer with 3 days time frame. It means we have three one-day candle. If you take the three one-day candle and you can replace it by one candle, which is hammer, strong hammer. That's why they say morning star is a bullish reversal. So does as hammer is a bullish reversal. Let's blend the bearish engulfing. You can take the open of the first candle, you take the close of the last candle, then you take the portion between open and close, and then you take the high and the low of the pattern. The equivalent is nothing but a strong shooting star with 2 days time frame. It means you can replace these two candles with 1 day time frame, and you replace it by a shooting star with 2 days time frame. So if the bearish engulfing is a bearish reversal, so does as shooting star is a bearish reversal. And both of them, they're very strong. So I have so many video on candlestick map blending. I am urging you to go and watch them. I am sure that you find it really interesting. I hope you find this video enjoyable and informative. Stay tuned for the next video, which will be coming soon. Wishing you all the best. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.